Okay, so welcome back to another video lecture. This is for Chapter 6. It's ultimately around audit planning. How do we plan the audit? We've kind of been moving a little bit more into the how of the audit, and so this is going to be a foundational chapter for us in terms of understanding how the audit is arranged, the timing of different um, tasks that we need to do, and how um, this process of collecting evidence fits into the overall audit process, and how do we get to the point where we can actually collect the evidence that we need. So let's take a look here. We've got a lot of 8 learning objectives here. Notice there's only one low priority. All the others are medium and high. And that's just because this is a pretty foundational chapter. It's a pretty important chapter. So this kind of lays the groundwork for what we're going to be doing going forward. And I've slightly rearranged the order. We're going to start with learning objective number 2 first, because this is really sequentially, if you think about it, happens before we do anything else in terms of deciding how we accept new clients as the auditor. So obviously there's a lot that goes into obtaining clients. You're going to be submitting proposals of the work to the client, and also be communicating with the prior auditor in terms of once you've gotten a sense of the engagement you want to do, then it's a good idea to talk to the prior auditor, because they're going to have insight, right? So what's their impression of the integrity of management? Did they have disagreements over the accounting that was done in the past? Now you have to have filings if you do have a disagreement when you change auditors, and so we would be able to see that from the filings as well, but we might want to get more information from a prior auditor. And we'll talk to them about different issues that possibly came up, and their understanding of why the change was made. So if they were fired, why were they fired? Or if they quit, why did they quit? And so again, we want to make sure we're not getting into a situation that's more risky than we realize. That's kind of the purpose of communicating with the predecessor auditor. So once we our proposal is accepted, then we're going to draft an engagement letter that kind of lays out kind of the contract, if you will, of how we're going to perform the audit. So obviously things like the name of the entity is going to be there, but then the more important pieces are what do we expect management to do during the engagement. So they have to acknowledge that the financial statements are their responsibility, internal control is their responsibility, compliance with laws and regulations is their responsibility. They're going to make sure that we have access to everything we need, accounting records and personnel, to do the audit. And then they're going to have to assert that they think the financial statements are free from material misstatement. They're going to have to do that anyway with a filing, because of Sarbanes-Oxley. They have to certify that they're free from material misstatement, but that's always been part of the engagement letter, even before Sarbanes-Oxley. And then it's also going to lay out what our responsibilities are as the auditor in terms of conducting it according to the relevant auditing standards, depending on whether it's a privately held company or a publicly traded company. And how our job is to obtain an understanding of the internal control and then to plan the audit accordingly based on our risk assessments. And then obviously communicating at different levels of the firm and outside the firm based on the auditing standards. So some additional items which are often there, some of them are definitely there. So the timing of the audit, like when are we going to come in and do interim work right throughout the year, or is it only going to be at year end? To what extent are we going to expect certain client personnel to assist us, whether we're going to use specialists or we may use the internal auditors of the firm for some of their work, rely on some of their work, and we'll talk about later when we can use their work versus when we can't. And obviously giving us permission to obtain information from those prior auditors, and fees and billing, like the amount and then the timing of the payments and those kind of things. Are we going to do an examination of internal controls, and then other limitations and conditions, right, that would be in there. So if we look at kind of the major steps, though, and how we do the audit process. So once we get the client, then planning the audit is first, obviously. Obtaining an understanding of the client's environment, assessing the risk of material misstatement, and then designing and performing the audit procedures for basically the testing, completing the audit, and then forming an opinion. Okay, we're going to come back to these steps over and over again. This chapter mainly is focused on that kind of the beginning pieces. We'll talk later about how to perform the actual audit procedures as we look at the different transaction cycles. And so this is a really nice graphic. I would highly recommend that you spend a good bit of time thinking about this, looking at this, studying this. As we go through, I'll bring this back up at different times. But this is a nice graphic of the 6 steps and some of what's included in each of those steps. So again, this is a nice summary of the 6 stages of the audit process. So moving on to objective 3, explaining the auditor's responsibilities for planning. So overall, we're going to develop an audit strategy and an audit plan. Thinking about the different ways in which we can staff the engagement, first, how do we use the client staff? So, for example, which staff do we need to get access to? Do we need are we going to use the internal audit group of the client? Are we going to need other CPAs? So maybe there's some subsidiary firms at different locations, and we need some work done by some local CPAs, whether that's local in the U.S. or local to where the foreign subsidiaries are located. Do we need some specialists? Are there maybe some complex derivatives that we need a specialist to look at? And then if we're doing the first year audit, communicating with the prior auditors and kind of establishing those beginning balances from the financial statements, right, from past financial statements. Again, if that's the first year audit. So that's kind of the big picture of what we need to do in terms of planning. Then let's think about the risk assessment that the auditors are going to use to get an understanding of what's going on in the client. So during the risk assessment period, we're going to do several things. Obviously, we're going to be talking to management and key individuals within the client, trying to get a feel for what are the issues, what are the significant transactions that happen throughout the year, were there any significant estimates that had to be made, or maybe there were some difficult decisions that had to be made around the accounting. So we're going to try and get a sense from them to the extent that they're willing to disclose. And we're going to do analytical procedures here. And again, this is looking at like the draft of their financial statements, and then seeing are there any large percentage changes? Are there any inconsistent changes between related accounts? Those kinds of things. And we're going to be reviewing a lot of documentation and in this period to see if there's any, so for example, let's say there was an M&A transaction, right? Well, there's a lot of documentation that gets kicked up when a firm acquires another firm, right? And so we would be looking through a lot of that information here on this risk assessment side. And then there's some other things that we might do in the risk assessment. Talking to legal counsel is a very important one, right? Are there any significant lawsuits that are sitting out there? Are there any areas in which there's non-compliance with laws? Those things are important, right? And um, there might be some external information as well. So if they're financial analysts, for example, that are following the firm, right? Have they had any kind of negative analyst reports this past year? So maybe they went from a buy recommendation to a hold and maybe even to a sell or a strong sell, right? So those would indicate kind of pressure on the firm. So if we kind of break this down a little bit, let's look at the nature of the client. How competitive are they within the industry? Who are their key competitors? That gives you a sense, excuse me, of the um, uh, pressures that they might face to manipulate financial reporting. How is the firm structured, right? How does authority get distributed throughout the firm? Um, that is going to play a key role in understanding who we need to talk to, who are in the individuals in the key positions that we're going to need to interface with. Obviously, we're going to review the different accounting policies and procedures that they use. You can get some of that information a lot of it from the past reports that were filed with the SEC, where they have to disclose significant accounting policies. Ownership structure, public, private. If it's public, are there large block owners, that own more than 5%? Are there any majority owners? Because again, we're trying to get a sense of the environment which they're operating in and what kind of pressures they might face. How have they financed the firm in terms of debt versus equity? What kind of debt do they have? Do they have publicly traded debt? Or do they have private bank loans? Those kind of things are important. Obviously, what products and service lines they have, because we want to understand the different transaction cycles and understand, obviously, if you're selling products that have a short lifespan compared to like a plane, for example, right? Those are very different sets of transactions that would accompany those different products. They're important business processes. We'll talk about those as we go. And internal control. Trying to get a sense of internal control at this point. Not doing a complete review or testing at this point. We're just trying to get a sense of it. We've already talked about some of these other factors in terms of competitive environment. What are the relationships like with suppliers and customers? Those are important. Are there significant technology innovations that have happened over the last year, either by the firm, which would suggest possibly some new transactions, or by a competitor, which would suggest now some pressure from the outside? Again, we're trying to understand what are the risks with this firm for misstating their financial statements. Obviously, understanding important laws and regulations that apply to them, because again, we have to evaluate non-compliance with those laws and regulations, especially as they directly impact the financial statements. How's the economy, macroeconomy, and also the industry economy? And then what are some of the barriers to entry for the industry in terms of, is it easy to get in the industry? That would suggest then that there's a lot of potential competitors that are out there. Or are there high barriers to entry, which would suggest that they have less pressure from competition, right? And then understanding kind of the dynamics between the suppliers and the customers, right? If there's some really large suppliers that really can dictate terms, that's a different scenario compared to a lot of smaller suppliers where our client gets to dictate the terms. So we're just trying to understand how the firm is operating, because we have to understand the process they're going to use to create financial statements. As far as kind of the next area of understanding their business, thinking about their objectives, right? What are they trying to achieve? Right? What are their goals? Right? That can give you a sense of where they might try to misstate the financial statements, how they are planning to achieve those goals, again, trying to give you insight into where you need to look and what are the risks to achieving those objectives. Again, trying to just get a sense of the firm, trying to understand where the risk might be. How do they measure performance, right? So budgets, we're going to look at their budgets. Um, that gives you a plan, right? If you remember from your cost class, the budgets basically help implement the plan. This is what we're planning to do. So we want to grow revenue. That means we're going to have to probably spend more money on marketing, for example, or on R&D to create new projects. And then what are they looking at for their key performance indicators? Like what do they think drives success in their business? Because again, that can suggest that certain individuals may try and manipulate that. Variance analysis, that's just the difference between the budget and actual. And so what areas are they struggling with? What areas are they underperforming? Again, that would suggest pressure possibly in those areas. And so if you remember from a cost, right, it's plan and control, right? So budgets are the plan piece. Variance analysis is the control piece. It tells you what you need to do as the firm. And that can also tell us as auditors where we need to look. The segment performance, I mentioned before that there's a footnote in the filings for segment reporting. We would look at that as well to see, are there certain segments that are doing better than others? Where might there be pressure to manipulate performance, right? Balanced scorecard, if they use it, just kind of gets to those key performance indicators, the ones that they use to run the business. And then do they have any external reviews? All right, so then moving on to another element of understanding the client's business, internal control. So we're going to need to understand how their internal control system is set up. And so at this point, we're focused on the design of internal control. We're not going to focus yet on how well it's operating. We're going to focus on the design. So what controls are out there, who executes the controls. It could be individuals, it could be information technology. If we have different types of transactions, how are those processed? How do those get put into the accounting information system? What kind of records are out there? What kind of documentation is kept for given transactions? Those are all things that we want to look at because they're going to tell us about how that internal control system is set up. Okay, so at this point we're just focused on design of internal controls. Okay, so another element here is the source of the information. Obviously, where we're going to get our information for doing this understanding. Where does that information come from? Obviously, we're talking to managers. We're going to also look at accounting and auditing guides. Sometimes the AICPA has these guides. Oftentimes, if you're at one of the big four firms or a national CPA firm, they're going to have their own guides for the different industries as well. Sometimes there are risk alerts around the industry that you would look at to see, okay, there's this new transaction popping up in this industry, and this are some of the key issues around how to do the accounting. So we would look at those. A lot of industries have their own trade journals or news publications, and so we would look to see what's going on in the industry. Again, just trying to understand this is where we're going to collect a lot of this information to understand the environment in which the client is operating. The government may have publications around different areas. Think about the financial services sector, right? It's a very highly regulated sector, and so there might be some government publications that are relevant. Obviously, we're going to be looking at prior annual reports and SEC filings, the 10Ks and the 10Qs. We'll be looking at proxy statements, and the 8Ks that would suggest material transactions or material events. So we're going to be looking at all of those things to get our information as well. Looking at prior tax returns, even though we're talking about the financial statement audit, the tax returns impact financial statements, right? Because we have to get to deferred tax assets and how much income tax expense and all that stuff we need to consider. And obviously, there's a lot of additional sources in terms of on the web as well. And then if it's a manufacturing plant, for example, we would take a tour, right, of at least one plant, if not multiple plants, to get a sense of what's going on within the firm. And then we would do some preliminary analytical procedures, kind of in this risk assessment, understanding the client business stage, just to get a sense of how things have been changing. Okay, possibly the statement of cash flows as well. So this graphic is from an academic paper, and I liked it because it has a nice graphical way to see this relationship between audit tenure, which is on the bottom axis here, and then percentage of failed audits. And so, as you see, the risk is going down with time, right? So we have this nice downward relationship between tenure and audit risk. If you think, I mean, that's ultimately what a failed audit is, right? It reflects the actual occurrence of audit risk. And so that's going down initially. But then somewhere around year 6 or so, this relationship flips and it starts going back up. And so this is just this idea of, right, in this down period, we're gaining experience, right? Years 1 through 6 or so, we're gaining experience. And so we're doing a better job of the audit. But then at some point, our independence might be impaired because we're getting too comfy with the client, and so it starts to tick back up, right? Now, it would have been nice to see if you drag this out even farther, where does this keep going up or does it stabilize, right? We don't know that from this graphic. But this at least represents the relationship between audit tenure and audit risk, or in this case, failed audits. Audit quality is another way you can say it. Okay, so looking at materiality here, we've talked about material misstatements several times, but we haven't defined materiality in a very rigorous way yet. And so this is where the art in audit comes in, right? So we're going to have to use our professional judgment in terms of what would a reasonable person consider to be a difference that matters in the decision they're making. Okay, and so materiality really is all about decision context. Would, for example, if we had revenue and the client, in our opinion, they had overstated revenue by 1%, would that be material or not, right? And so how do we get to that place of trying to process that? And so we're going to consider quantitative and qualitative factors. And so the quantitative factors are the easiest ones, right? Oops, there we go. And, quantitative would be things like 1% of sales, or 5% of net income, or 10% of net income. Those are kind of quantitative factors we could use. Qualitative factors would be things like, would the difference impact whether you met analyst earnings forecast or not? Would the difference would it basically move you from a loss to a gain, or a loss to a profit in a year? Would this difference impact whether or not you increased or decreased your earnings from last year, right? So those are different qualitative thresholds or qualitative factors that you'd have to consider as an auditor in addition to the quantitative. And so how are we going to use it? We're going to use it when we plan. First, at the overall financial statement level, what do we think is a material amount of difference? And again, we could, maybe for the balance sheet, we'll have one threshold based on total assets. Maybe for the income statement, we would have a threshold based on total sales. And then what we'll do is we'll take that materiality, like what is the materiality range, right? Is it 5% of net income? Well, then we need to allocate that to the individual accounts in order to see what would impact what we consider to be a material amount for each of the financial statement accounts. So it's used in kind of planning purposes, and that materiality helps us decide on, the nature, the timing, and the extent of our audit procedures, which we'll talk about again later. And then it'll be used to also evaluate the findings when we get the results back in and we have a difference. Hey, is this a material difference or not? Well, we go back to our planning materiality to evaluate it. The FASB and the PCAOB have slightly different but still similar definitions. FASB says something is material if omitting it or misstating it could influence decisions that users make on the basis of financial information, right? So again, it's a decision context, and could that information influence their decision? The PCAOB says something's material if there's a substantial likelihood that it would have been viewed by a reasonable investor as having significantly altered the total mix of information made available. It's a little more technical definition, but it's still pretty similar, right? Decision context, would it impact from a reasonable person's decision for using the information from the financial statements?